Welcome, everyone. You're here because, well, you're trying to get a better handle on your money, right?
That's usually the goal.
Yeah, especially figuring out that whole saving versus investing puzzle and, how to actually move towards those big financial goals that sometimes feel pretty far off.
It can seem daunting.
It really can. But you've come to the right place. We've done a serious deep dive into a whole stack of resources for you. We looked at everything from smart ways to manage cash short term to how teens can get started with investing.
We also dug into budgeting techniques and, importantly, those common financial traps people fall into.
Exactly. So our mission today is pretty straightforward. Pull out the key insights, the really practical advice from all this material, and give you a clearer path forward for your finances. Sound good?
Sounds like a plan? Let's start with the absolute foundation, saving.
Okay, saving. What exactly are we talking about?
Well, at its core, saving is deliberately setting aside money, putting some of your income away for future use.
And where does that money usually go?
Typically, it lands in places that are really easy to access. Think high-yield savings accounts, maybe cash management accounts, or money market accounts.
Right.
The big appeal here, and this comes up in sources like Investopedia and Morgan Stanley, is safety and liquidity. How safe it is and how quickly you can get your hands on it.
So very low risk.
Extremely low risk. That's why saving is, well, perfect for those shorter-term goals, like saving for a holiday or maybe the down payment on a car, and definitely for building up that emergency fund we all need.
That makes sense. There's a certain comfort in knowing that money is secure. And often, like you said, these accounts have insurance, right? Like FDIC or NCUA.
Exactly. That insurance protects your principal amount, which is crucial for savings.
But there's a catch, isn't there? I remember seeing something about inflation.
Yes. That's the flip side. Sources like HSBC UK and the Dollar School point this out. While your money is safe, the interest you earn on traditional savings, well, it might not always keep up with inflation, meaning even though the number in your account stays the same or goes up a tiny bit, what you can actually buy with that money, its purchasing power, could slowly decrease over time.
Okay, so safe, accessible, but maybe losing a bit of ground to inflation long term.
That's the trade-off,
Yeah.
yes.
So if saving is about safety and short-term needs, what about investing? How does that differ?
Investing is fundamentally different. It's about putting your money to work. You're buying assets, things like stocks, bonds, mutual funds, hoping they'll grow in value or generate income.
So the goal is higher returns than just saving.
Precisely. The potential for greater growth is the main driver.
Hmm.
But, and this is a critical point stressed by Investopedia, the Phnom Penh Post, Morgan Stanley, pretty much everyone, this potential comes with risk.
Risk, meaning you could actually lose money.
Yes. Unlike insured savings accounts, the value of investments can go down as well as up. There's no guarantee of return, and you could get back less than you put in.
So investing isn't really for money you might need next month then.
Generally, no. Investing is usually seen as a strategy for longer-term goals. Think 5 years or more down the road. Fidelity International and Morgan Stanley often use that 5-year mark as a rough guideline.
Like what kind of goals?
Big life goals, mostly. Retirement is the classic example. Funding a child's education, saving up that substantial down payment for a house. Things that are quite far in the future.
Okay. But you mentioned earlier something about short-term cash strategies.
Mm.
Is there something between basic saving and long-term investing?
Yes, there is. There's a category we can call short-term investments. It's kind of a middle ground.
A middle ground? How so?
Well, these options aim to offer a bit more return than basic savings, potentially, but still prioritize stability and liquidity.
Hmm.
They're designed for money you think you'll need within, say, the next 1 to 5 years.
Interesting. What kind of things fall into this category?
Bankrate actually has a good list. Some overlap with savings, like high-yield savings accounts and cash management accounts, because they balance access and return relatively well. But it also includes things like money market accounts or money market funds. Slightly different things. They're short-term bond funds, which might hold corporate or government debt, and even short-term CDs, certificates of deposit.
These, right. Those lock up your money for a set time, usually.
They do, but you can get them with shorter terms, like 6 months or a year, which fits that short-term horizon while often offering a slightly better interest rate than a standard savings account.
So if someone is considering these short-term investments, what should they be looking for? What makes a good one?
Stability is probably number one. You don't want the value jumping around wildly if you need the cash relatively soon. Bankrate emphasizes this. Liquidity is also key. How fast can you get your money back without facing penalties?
And costs.
Yes, low transaction costs are important too. You don't want fees eating away at what are likely to be modest returns anyway.
So it sounds like the main focus is still preserving the money, not necessarily hitting it big.
Absolutely. That's a crucial point Bankrate makes. Don't get tempted by a slightly higher potential return if it means taking on significantly more risk with money you need soon. For short-term goals, safety and accessibility really should be your top priorities.
That makes a lot of sense. Okay, so we have saving for safety in short term, investing for long-term growth with risk. But why are we doing either? What's the driver?
That brings us to goals. Financial goals. It might sound basic, but having clear goals is incredibly powerful.
How so?
Well, sources like Shepherd's Friendly and articles on the benefits of saving really highlight this. When you have specific, realistic, and measurable goals, your saving habits tend to improve dramatically. It gives your saving a purpose, a why.
Instead of just putting money away vaguely.
Exactly. It's the difference between saying I should save more and I need to save $200 a month for the next 2 years for a down payment on a car. One is fuzzy, the other is a concrete target.
And these goals can be different lengths, right?
Absolutely. Morgan Stanley points out that goals span different time frames. You might have those short-term ones we mentioned, a vacation, that car, medium-term goals, maybe saving for a wedding in 3 years, and then the big long-term ones like retirement or buying a house decades from now.
It helps to break it down like that, but before people start mapping out, their retirement yacht,
Yeah.
is there something they should do first?
Yes, 100%, yes. Build an emergency fund.
The rainy day fund.
Call it what you will, but it's non-negotiable. Fidelity International, One Family, tons of savings strategy resources, they all hammer this point home. You need a cushion.
How big a cushion are we talking?
The general rule of thumb is 3 to 6 months worth of your essential living expenses. Rent or mortgage, utilities, food, transportation, insurance. The absolute must-pays.
And where should this emergency money live? Not invested, I assume.
Definitely not invested. It needs to be in an easily accessible, low-risk place. Back to those high-yield savings accounts or money market accounts we talked about. Safe and liquid.
Why is this step so critical?
Because life happens. Unexpected things crop up: a job loss, a medical emergency, urgent home repairs. Your car breaks down. As the benefits of saving money points out, this fund acts as your financial shock absorber.
So it stops you from having to dip into your long-term investments or go into debt?
Precisely. It prevents a temporary setback from completely derailing your carefully laid long-term plans. It protects your investments and keeps you out of high-interest credit card debt, if possible. It's foundational.
Foundational. Okay, that's clear. Now, shifting gears a bit, investing can seem very rational, numbers-driven, but there's an emotional side too, isn't there? Especially maybe for newer investors.
Oh, absolutely. The emotional aspect is huge and sometimes overlooked. The Financial Conduct Authority, the FCA in the UK, did some interesting research on this.
What did they find?
They found that for some, especially younger people getting into investing, the thrill of it, or maybe the social status they feel, comes with investing in certain things, particularly high-risk ones. Well, that can sometimes outweigh the practical, functional reasons for investing.
So excitement over logic.
In some cases, yes. There can be a disconnect between the buzz of participating and a real understanding of the potential financial impact if things go wrong, like really internalizing that you could lose a significant amount of money.
That sounds risky.
It can be. The FCA research also noted a degree of overconfidence among some newer investors. They might rely more on gut feelings or maybe rules of thumb they've picked up, perhaps from social media, rather than deep research or understanding the actual risks involved.
That ties into warnings about get-rich-quick schemes, I suppose?
Exactly. NatWest specifically cautions against this temptation, especially in areas that are less regulated, like, say, certain cryptocurrencies. It can seem like an easy path to wealth, but the risks are often substantial and not well understood.
So what's the advice there?
Do your homework. Seek out independent, unbiased advice if you can. Don't just jump on a bandwagon because it seems exciting or you see others doing it. Understand what you're putting your money into.
Solid advice. Okay, let's talk about something more positive associated with long-term investing. Compound interest. It gets mentioned a lot. Is it really that big a deal?
It's arguably the biggest deal for long-term wealth creation.
Yeah.
Focus on the Family Canada and Investopedia both really emphasize its power.
Explain it simply. What is it?
It's basically earning returns on your returns. Your initial investment earns interest or grows. Then the next period, you earn returns not just on your original amount, but also on the accumulated interest or growth from the previous period.
So interest earning interest.
Exactly. It creates a snowball effect. Focus on the Family candidate had a great example. Let's say you invest $100 and earn 8% a year.
Okay.
If you pull out that $8 profit each year, after 20 years, you made $160 in interest. And you still just have your original $100 principal, so $260 total.
Right.
But if you leave that $8 in, reinvest it, so the next year you earn 8% on $108, and so on. After 20 years, thanks to compounding, that initial $100 could grow to over $466.
Wow, that's a huge difference. Almost double the outcome just by reinvesting the earnings.
It's incredibly powerful over long periods. And the key ingredient is time.
Time.
Yes. The earlier you start investing, even if it's just small amounts, the more time you give compound interest to work its magic. Focus on the Family Canada illustrates this really well, too.
How so?
They show how delaying starting your investments by just 10 years, say, starting at 35 instead of 25, can result in a significantly smaller final sum, even if you invest the same amount each month. Time is your biggest ally here.
So the message is start early, even if it's small.
Absolutely. Don't wait until you think you have a large enough amount. Start now with what you can afford. Consistency over time, combined with compounding, is the path to significant long-term growth.
Okay, so to harness this compounding, we need to invest. What are the main ways people typically invest for the long term? What are the options?
There are several main categories or asset classes. Investopedia gives a good overview. You have stocks, for instance.
Owning a piece of a company.
Right. Exactly. You buy shares of stock, you become a part owner. The potential return comes from two places: the stock price going up over time, and sometimes dividends, which are portions of the company's profits paid out to shareholders.
But stocks can be volatile.
They certainly can be. Their prices can swing up and down quite a bit, especially in the short term. So there's higher potential reward, but also higher risk compared to some other options.
What else?
Then you have bonds. Think of bonds as loans. You're lending money to a government or a company.
Okay.
In return, they promise to pay you back the loan amount at a future date, and along the way, they usually pay you regular interest payments. Generally, bonds are considered lower risk than stocks, but they typically offer lower potential returns as well.
So stocks for growth potential, bonds for maybe more stability and income.
That's a common way to think about it, yes.
Okay.
And then there are funds, mutual funds and exchange-traded funds, or ETFs.
How did those work?
Funds pool money from lots and lots of investors together. A professional manager then uses that pool of money to buy a wide variety of stocks, bonds, or other assets.
Ah, so it's instant diversification.
Exactly. That's the main benefit. Instead of you having to pick individual stocks or bonds, you buy shares in the fund, and you instantly own tiny pieces of all the investments held by that fund. It spreads out your risk significantly.
That sounds appealing, especially for beginners.
But a very popular way to invest for that reason.
Now, you mentioned tax advantages earlier. How do those fit in?
Right. Many countries offer specific types of investment accounts that give you tax breaks. The goal is to encourage people to save and invest for the long term, especially for retirement.
Can you give examples?
Well, the Focus on the Family Canada source mentioned Canadian accounts like TFSAs, tax-free savings accounts, RRSPs, registered retirement savings plans, and the newer FHSAs, first home savings accounts. In the UK, Free Trade talks about ISAs, individual savings accounts, and SIPPs, self-invested personal pensions. The US has 401k, IRAs, Roth IRAs, and so on.
So the names differ, but the idea is the same.
Pretty much. These accounts allow your investments to grow either tax-free or tax-deferred. That means you pay less tax or delay paying tax on the investment gains, which allows your money to compound even faster over time. Using these accounts when available is usually a very smart move for long-term goals.
Good tip. Okay, I saw an interesting phrase in the research. Someone on Reddit mentioned, saving is deferred spending. What's that about?
Ah, yeah, that's from the YNAB subreddit, I believe. It's a simple but profound way to reframe how you think about saving, especially long-term saving.
Deferred spending. So money you're planning to spend later.
Exactly. Instead of seeing your savings or investment balance as just a number, or money that's locked away and inaccessible, think of it as money you've specifically allocated to spend on something important in the future.
Like retirement living expenses, or that house down payment, or kids' college fees.
Precisely. It connects the act of saving today with the tangible future benefit you're working towards. It makes the goal feel more real and the saving less like a sacrifice, perhaps. It's money for something, just later.
I like that perspective. It makes it more purposeful. Okay, let's get really practical now. Are there some general rules of thumb, some basic guidelines people can follow for managing their money day to day and setting up their finances?
Definitely. Free trade offered some really solid, actionable principles. First off, a big one. Tackle high interest, unsecured debt first.
Like credit cards, store cards, payday loans.
Exactly. The interest rates on those can be crippling, sometimes 20%, 30%, or even higher. Paying those off aggressively should almost always be the top priority because the interest costs you way more than you're likely to safely earn through saving or even investing in the short term.
Makes sense. Get rid of the financial drag first. What else?
Pay yourself first, or, as Free Trade puts it, pay your future self. Set up an automatic transfer. As soon as your paycheck hits your account, have a predetermined amount automatically moved into your savings or investment account. Don't wait to see what's left over at the end of the month.
Make saving automatic and non-negotiable.
Yes. It turns saving into a habit, a fixed expense, rather than an afterthought. Hugely effective.
Okay, automatic saving. What about budgeting? Is there a simple framework?
The 50-30-20 rule is a popular starting point mentioned by both Free Trade and folks on Rhinab. It's a guideline, not rigid law, but it can be helpful.
How does it break down?
Roughly, 50% of your after-tax income goes towards needs, housing, utilities, food, transport, insurance minimums, the essentials.
Okay.
30% goes towards wants, lifestyle choices, dining out, hobbies, entertainment, clothes beyond the basics, the fun stuff.
And the last 20%?
That remaining 20% is allocated to your financial goals. This includes paying off debt beyond minimum payments, building your emergency fund, and investing for the future.
Needs, wants, goals. 50, 30, 20. Seems like a decent starting point to understand where your money is going.
It is. And Free Trade also makes a good point. You'll likely be saving for multiple goals simultaneously. You might be putting money towards a short-term holiday fund and your long-term retirement plan. That's normal and necessary. It's about balancing priorities.
Right. Okay, so those are general money management tips. What about specific rules or guidelines for investing itself?
Free Trade hits on some key investing principles too. First, and we've said it before, but it bears repeating, build that emergency fund before you start investing seriously.
Protect the downside first.
Absolutely. Then, a big one for investing strategy. Invest regularly. Don't try to time the market.
Meaning, don't try to guess when the market will hit bottom to buy low or peak to sell high.
Exactly. It's incredibly difficult, maybe impossible to do consistently, even for professionals. A much more reliable approach, suggested by both Free Trade and Barclays Smart Investor, is to invest a fixed amount at regular intervals, say, every month. This is sometimes called dollar cost averaging or drip feeding.
How does that help?
It smooths out your purchase price. When the market is down, your fixed amount buys more shares. When it's up, it buys fewer. Over time, it reduces the risk of investing a large sum right before a market drop. It enforces discipline.
Consistency over timing. Got it. What else?
Understand yourself. Free Trade emphasizes knowing your own risk tolerance. How much volatility can you stomach emotionally and financially? Your time horizon, how long until you need the money? And your specific goals. These factors should guide your investment choices.
So no one-size-fits-all portfolio.
Definitely not. And related to that, use those tax-efficient accounts we discussed, ISAs, SIPPs, 401ks, whatever's available to you to maximize your returns over the long run.
Makes sense. Any other core investing principles?
Diversification is crucial. Don't put all your investment eggs in one basket.
We touched on that with funds.
Yes, funds are one way to achieve it, but the principle applies broadly. Spread your investments across different asset classes, stocks, bonds, maybe real estate, etc., different industries, and different geographic regions. Free Trade, Barclays, Investopedia, they all stress this. It's fundamental to managing risk. If one part of your portfolio does poorly, other parts might do better, cushioning the overall impact.
Diversification, diversification, diversification. Okay. Now, on the flip side, what are some common money mistakes people should actively try to avoid?
One family had a good list of common pitfalls. A big one is simply overspending and impulse buying, letting those small, unplanned purchases constantly derail your budget.
The daily latte effect, maybe?
It can be, or bigger things, too. Related to that is relying too heavily on buy now, pay later services. They seem convenient, but can encourage overspending and lead to debt if not managed carefully.
What else is on the list?
Ignoring small costs that add up, think subscriptions you don't use, or slightly higher fees you could avoid. Borrowing too much in general, whether it's credit cards, loans, or even mortgages that stretch you too thin. Falling for financial scams, which are sadly becoming more sophisticated.
That's a scary war.
It is. And finally, a huge one. Not saving for retirement early enough or at all, thinking it's something you can worry about later.
So how do we combat these? What are the practical strategies?
Budgeting is key for the overspending track where your money goes. One family suggests maybe having separate accounts for needs and wants to create clearer boundaries.
That could help.
For impulse buys, try to identify your triggers. Is it stress, boredom, seeing ads? Then find coping mechanisms that don't involve spending. The emergency fund helps avoid borrowing for unexpected costs. Staying vigilant and skeptical is your best defense against scams. If it sounds too good to be true, it probably is.
And retirement.
Start now. Even small amounts consistently add up over decades thanks to compounding. Make it a priority from your very first paycheck if possible.
Okay, that's really practical advice. Now, what about teenagers? We mentioned sources on teen investing. Is the advice different for them or for parents guiding them?
The core principles are largely the same, but the emphasis shifts slightly. Both the importance of saving early and Investopedia really drive home the massive advantage teens have: time.
The compounding factor again.
Exactly. Starting to save even tiny amounts as a teen can lead to incredible results by retirement age, simply because the money has so many decades to grow. It also helps them build good financial habits early on.
What else should teens focus on?
Being prepared for life after school, having some savings can make that transition much smoother. Building a good credit history, which starts with responsible money management. Understanding the difference between saving, safe, short-term, and investing. Growth potential, risk, long-term.
And can teens actually invest?
Yes, often through custodial accounts, which Investopedia and TeenVestor mention. These are accounts opened by an adult, parent or guardian, on behalf of the minor. The adult manages it until the teen reaches legal age, but it's a great way for them to learn with oversight.
So the advice for teens is create a budget, set some goals, understand saving versus investing, and start early if possible, maybe with a custodial account.
That's a great summary. It's about building that foundation early.
Okay, we've covered a lot of ground saving, investing, goals, risks, strategies, mistakes. How do people pull this all together? How do they find the right balance for themselves?
That's the key question, isn't it? Finding your balance. And as both Fidelity International and Morgan Stanley really emphasize, it's a personal equation. There's no single right answer.
It depends on the individual.
Completely. It depends on your current financial situation, your income, your debts, your specific short-term and long-term goals, your age, how much time you have until you need the money, and very importantly, your personal comfort level with risk.
So someone closer to retirement probably needs a different balance than someone just starting their career.
Generally, yes. Someone with decades ahead of them might lean more towards growth-oriented investments, accepting more volatility. Someone needing the money sooner might prioritize capital preservation and have more in safer, saving-type vehicles or short-term investments. It's about tailoring the strategy to your unique circumstances.
Finding that healthy balance between saving for today's needs and emergencies and investing strategically for tomorrow's growth.
That's the goal, a dynamic balance that likely evolves throughout your life.
All right, let's try to summarize the key takeaways for everyone listening. What are the absolute must-know points from this deep dive?
Okay, first, understand the difference. Saving equals safety, liquidity for short-term needs and emergencies. Investing equals potential for higher long-term growth, but involves risk.
Right. And don't forget, short-term investments is that middle ground for goals within about 5 years, prioritizing stability.
Absolutely. Second, goals are crucial. Set specific, measurable financial goals. They provide direction and motivation for your saving and investing.
And before chasing those big goals, build that emergency fund. 3 to 6 months of essential expenses in a safe, accessible account. It's non-negotiable.
Couldn't agree more. Third, harness the power of compound interest. Start investing early, even small amounts, and be consistent. Time is your greatest asset.
Don't try to time the market. Invest regularly.
Exactly. Fourth, understand the basics of different investment types: stocks, bonds, funds, and critically, the importance of diversification to manage risk.
Spread your money around. Don't put all eggs in one basket.
You got it. Fifth, be aware of the emotional side of investing. Avoid making decisions based on hype or fear. Understand your risk tolerance and beware of get-rich-quick temptations.
Do your research. Maybe seek independent advice.
Yes. And finally, learn from common mistakes. Avoid overspending, manage debt wisely, especially high-interest debt, be vigilant against scams, and prioritize retirement savings early.
And for teens, the message is loud and clear. Start early. Build those habits, understand the basics, and let compounding work its magic for decades.
That covers the main pillars, I think.
Great. So, for everyone listening, we really hope this discussion has given you some clarity and practical ideas. The next step is yours.
We encourage you to really take some time to think about your own situation. What are your goals? Short-term, long-term? What's your comfort level with risk? How does the balance between saving and investing look for you right now?
Maybe sketch out a basic budget using the 5-30-20 rule as a starting point. See where your money is actually going. Identify one high-interest debt you could start tackling more aggressively.
Consider the strategies we talked about. Automatic saving, regular investing, using tax-advantaged accounts if they're available to you. How could you incorporate those?
This deep dive was meant to give you a solid foundation. But remember, finance is personal. You might need to dig deeper into specific investment options that suit your goals, or maybe explore different budgeting tools or techniques that click with you.
It's an ongoing process of learning and adjusting.
Definitely. And that brings us to our final thought for you to take away. We talked about how time is perhaps the most valuable asset you have when it comes to building long-term financial security through investing and compounding.
So the question is,
Considering that, what's one small, concrete step you'll take today, not tomorrow, not next week, but today, to either kickstart or refine your own personal financial journey?